Will the next Fed move be to lower rates? CME's federal funds futures markets, as of the first trading day of 2019, offered the interesting prognosis that there would be no rate moves at all by the Federal Reserve in 2019. Even more importantly, the view for the January 2020 FOMC meeting was that there was a 24% probability of a rate cut versus only a 9% probability of a rate rise. This view is, of course, at odds with the recent guidance from the Fed, which has suggested a few more rate rises are coming in 2019. Although the Fed always reminds us that it is data dependent, and if the facts change, so will the guidance. Now, those market participants holding expectations of a rate cut are basing the view on the possibility that the unemployment rate will begin to rise in 2019. The last available data showed an unemployment rate below 4%, very low. But here's the deal. There are worries, not so much about a full-fledged recession as about the possibility of the unemployment rate starting to creep higher in the future. The job market worries stem from a myriad of fears, including, among others, U.S. rates rose in 2017 and 2018, and interest rate rises always hit the economy with a lag. We worry about housing, we worry about autos. Anything we buy on credit could be hit. China's economy is slowing down, and it might impact other economies around the world, even U.S. exports. The U.S. government partial shutdown probably made little difference to the economy, but the debt ceiling debate, which is coming later in 2019, could be a much bigger negative. Is the U.S. governmental gridlock making the economy riskier? The Fed's views of inflation pressures basically depend on the robustness of the labor market. If the unemployment rate rises, even incrementally, a data-dependent Fed could switch directions. Not a forecast, just a possibility, and that is what the Fed funds futures markets are watching. Blue Putnam, Chief Economist, CME Group.